James, how are you?
Very good. Thanks for having me, Burak.
My pleasure. You have a PhD in biotechnology from Cambridge. How did you make the transition to academia to entrepreneurship and then investing?
Well, so when I did my PhD, I was actually sponsored by industry and I built some technology there that we then ended up licensing to a public listed company. And, the entire Institute of Biotechnology was incredibly entrepreneurial. Every person there built some technology that had a commercial application. And I thought, this is super interesting, this whole technology, building it for businesses, bringing that into society and bringing improvements to society. I just thought it was really fascinating. Anyway, so after I did the PhD, I left and I then went into a startup where they said, okay, why don't you analyze biotech companies for us and you tell us whether they're interesting for VCs to invest into. So I started off doing that, and then I analyzed more companies. Eventually, I was the head of analysis and I analyzed, thousands of privately held companies.
Before becoming an investor, you were a founder and CEO yourself. What key lessons did you learn from your experience leading a startup?
Well, so after this initial job that I had, I left, and together with two co-founders, I started a business. And when you start a business, obviously you want to, find product market fit, ramp up customers, run a great company. And what you learn when you try to do that is that there are so many things that can go wrong. And it's like a never-ending list of things that can go wrong. And the reality is that the vast majority of these problems that you encounter, other people who've gone before you have already solved. So you don't need to learn everything yourself. It's literally completely unnecessary. So what I did was I then thought I should find mentors who've already done lots of these things, get their advice and improve my ability to execute. And then when I had done that and I became better at it, I thought I should do the same thing and find other founders and maybe I can mentor them a bit and I can help them avoid mistakes. So I started doing that. And then because of that, because I was just doing that for no fee or equity or anything, I just thought it was the right thing to do. The accelerator program, the first one in the UK, which was a Techstars associate program called Springboard, approached me and said, do you want to become a mentor in the program? So I said, okay, I can do that. So I went there and I mentored and, I did more and more mentoring. And then at that time, I had some more money. So I was able to start making angel investments at around that time and into companies. I thought it's kind of nice when I find companies that I like, I can put some money and then I have the reward from mentoring.
Lots of countries are competing with the talents, especially startups area. How is Germany is doing, especially government perspective?
I think this has changed a lot earlier this year. We have yet to see what the actual impact is of the policy changes that have been made. I actually think if you take a step back, the problem in Germany is one where, believe it or not, but in German society, running a business is actually not part of the general education process. There was a book published a few decades ago that says this is a summary of everything that a German person has to know. There's a single piece of knowledge about business in that entire book. It just doesn't exist. So you could say high society frowns on money. There's a real deep-seated cultural problem in Germany, which probably goes back to the Second World War. But anyway, and that sort of fundamental mental mindset got disrupted in around 2000 or something like that. And actually largely by rocket internet, because what happened was there was suddenly a path where you could follow the normal path as an entrepreneur, and then you have a switch into startup land. Right? Because of that, it built enough critical mass of companies and of people to actually build companies. And then a few years later, around 2014, 15, that's also the time when I came back to Germany coincidentally. That was the time when lots of founders started to build companies and you could actually have a functional business as a VC or as a business angel. And it is really interesting that none of that had anything to do with the government at all. There have been no government initiatives in Germany of note where I would say they've been fundamentally helpful in pushing the startup ecosystem. I mean, everything that's happened here has happened despite the government and not because of the government. So recently they've actually enabled us to have normal stock option schemes like you're supposed to have, which is nice. Why we haven't happened for 20 years, nobody knows. They've made it easier to run venture capital funds in Germany, which again, that's really good. Why we haven't done that 20 years ago, nobody knows. And there are many other things like that. So it's just gradually the barriers against normal functioning of startups to be established in Germany has been removed away. I mean, Germany is like one of the top 3 countries, obviously, in Europe in terms of venture capital being deployed. So, I mean, it is doing okay, but it's not because of the government, right? It needs to be said.
So the Baltics and Nordics has been, especially in the startup ecosystem, has been very successful for the last decade or 2 decades, especially Estonia, Finland, Latvia, Lithuania, Sweden. There are lots of networks, small networks, which created probably the cold start problem in order, for example, if you have a successful unicorn, then the others can also follow this route or roadmap of the first one. Are there any networks in Germany that created these kinds of startup culture?
Yeah, that's what I just said. I think the most important initial network is probably the Rocket Internet Network. I mean, if you think about it, sort of like one of the first and probably most successful seed funds in Germany, Point Nine, it comes from that network, right? It comes from that kind of overall sphere. Founded, there was this competing startup studio that was similar to Rocket, and out of that was called Team Europe, and out of that came Point Nine. Yeah. So the startup studio scene in Germany, that was the first wave. Then you have obviously a different, somebody like one of the oldest VC firms in Germany, Early Bird. They've been very good at bringing up people and then letting them go. Let's say that in that way. And they've founded, lots of very, very good VC funds. So the partners have now gone to Creandum or wherever. So you have those. You have various different startups that have been created that have spawned more startups. From one ignition point or 2 or 3. You 10 years later, 15 years later, you have a pretty vibrant network of people. If anything, I mean, quite possibly the only government initiative, although it's not really government, but it's an institution, is in Munich. The university there has been very, very good at building a technology startups because they've got a very good course there that sort of mixes technology and business in a certain way, focused on startups. And the CDTM that's a really unusual activity that's been going on. So we can talk about other networks too. The Techstars network, other networks and so forth.
You have Techstars and you are aware of lots of acceleration programs around the world. Do we need acceleration programs anymore?
That's a really good question. I'd say so. The acceleration programs were super useful when you have a city where you are either at below critical mass or just below critical mass or at around critical mass. These acceleration programs can pull a whole bunch of people together and focus the energy on a small number of entrepreneurs. And that can be really, really useful. I think what has happened over the last, certainly since the pandemic, but even years before then, was that most of the investment business is actually being conducted online, right? I mean, we're talking here via video. And so in that way, what you can do is you can make investments like you do in places where you've never been and founders that we've never met in person. And so therefore, there has been a disassociation between where people are and where they invest, or the whole interaction has sort of shifted. It's a bit like, I don't know, and that has most certainly happened. So number one. Number two, there's just far more money around. There is so much money. Good founders can find good people, contact them easily, and get money from them. So finding money or also finding advice is no longer so critical. And the third point is that over time, because of the influx of the digitization and because there is more money, the accelerator programs have to change their offering to stay competitive. So Y Combinator has done a really good job at saying, oh, okay, you get for whatever is 7% ownership in the company. Now we give you 3 most favorite nation check. And then whatever comes next is basically part of that, which means net they get about 10% in each company. Now it's pretty smart because if you said, hey, I want to have 10% of your company for 5 years, the founders probably wouldn't come, but because of this splitting of the offering, it's like slay of hand, right? So you don't really have to pitch it like that. And then in addition, you get access to the network, you get reputational effects, you get access to the database with all the investors, so that's just pretty successful. So, but I think for most accelerators, if you look at the returns, the reality is even 10, 15 years ago, there were a very small number of accelerators who seriously made money. Yeah, and most just didn't. So, but today the number of accelerators that are seriously making money has shrunk further and further and further. Yeah, and I think therefore, I personally, there's a reason why I left accelerators behind 7-8 years ago. I personally don't want to run accelerator programs.
So you have been an active angel investor in Europe. What keeps you so energized and engaged in this work?
And look, it's the fun in investing is when founders win. The companies win and the founders win. It's just awesome. I had a dinner the other day. So I have a portfolio company that I backed. First check into that was in 2015. So I said to them, when you cross 100 million ARR, I'll fly I'll fly to your headquarters and we'll have a really nice dinner. So I was able to go there in January, like last a month ago, and we had a really nice dinner. And I think I know 100 million euro or something like that. And it's, I don't know, I've forgotten, it's like maybe 700 people in the company or something like that. So suddenly you go from 3 people with a PowerPoint to like a real business. It's growing and profitable and whatever. I think it's awesome. Yeah, I mean, that really, if you can spend your life helping founders get there, why shouldn't you do that? It feels like an incredibly noble thing. The other thing is, when you look around you, where you sit, everything you can look at has been made by technology. Every single piece, even the plants in the pot somewhere, it's probably been engineered somehow over years of cultivation. And everything has been made. The table, the computer, the wall, everything is technology, right? So it's really what differentiates us from the animals. And if we can invest in technology, and the technology progress takes society and humanity forward, I think it's just awesome. And it's great fun and it makes money. And so I think it's intellectually stimulating. So I think it's overall, it's a great thing.
You are one of the active angel investors in Europe. So how many investments did you complete since you started investing?
Oh, I don't know. I mean, I personally have made or been involved with over 200. Yeah, probably. I mean, at Angel Invest, we currently make in December, we made 4 investments, in January 4, and in February 5. So that's sort of so it's like 4 to 5 a month, say 50 a year. That's sort of how many investments we currently make. Yeah.
Are they convertible loans, safes, or equity rounds? How do you invest, by the way?
Oh, I mean, many of these investments we've done everything, all of the convertible debt notes, the warrants, I mean, the safes, the advanced subscriptions, or whatever that is, or equity rounds, doesn't really matter. I've got a full-time CFO who reads contracts and wires cash and signs. And at some point I decided I can't read contracts anymore, so I better build out the team to have somebody there who does this professionally.
So you personally invest, and also, do you also manage a VC fund?
Yeah, we actually, so at Angel Invest, which Angel Invest is the super angel fund that I'm investing out of, and it started off being my personal investment vehicle, and then it morphed over time into a more fully fledged investment company. We now have 50 million euros that we're investing, and we are now 11 people, full and part time, who are doing that. Almost everybody writes checks, so we have 9 people who write checks and coach teams, 1 full-time CFO, and then my co-founder Oliver helps me look after our LPs. And that's sort of how we do that.
What do you look in founders and startups before investing?
Yeah, the question is still having a bit of a unusual. I mean, we think about it as fail and scale, right? So the startup can only be successful if it doesn't fail. And the failure reasons in early stage startups are always the same, right? It's either the founders fight, or they can't figure out what customers want, or they can't give it to them. But if you don't find if you don't fight and you can figure out what customers want and you can give it to them, you're probably going to be okay, right? There will be a business, you will make money, customers will be happy, and that's sort of that. Now, that doesn't mean that this company is going to scale massively. So that's the other part, is the scaling bit. So that requires a certain market, it requires a certain business model, it requires, competitor landscape or overall landscape, plus obviously the willingness of VCs to pour lots of money in. Yeah. So because only then a company can really accelerate drastically or go quickly. So it's sort of, those are the things. So we don't want companies to fail. So we look for certain founder setups, and we want companies to be able to scale. So we look for certain business model market combinations, right? And competitive landscape situations. And that's sort of how we think about that. And, at the end of the day, all of those things need to line up. It's a bit like in in Thor, right? It's when all these spheres align once every few years, and then there's some magic that happens, and then there you get sucked up or whatever. But it's like the startup literally just gets accelerated because everything lines up, and that's sort of like, that's when a company wins, and it's really quite magical.
You have 2 portfolio companies. How involved are you with these portfolio companies after investing? It should be very difficult.
So we coach every team for at least 1 year. So when I invest in a company, I set up 27 calls with, so it's typically every 2 weeks for 30 minutes. I try very hard not to tell them what to do, because I think it's stupid. I mean, it doesn't work and it doesn't make any sense, because, it doesn't work because the most interesting questions typically have no intuitive answer, and founders are really not the people who need somebody to tell them, or want somebody who tells them what to do. So, but what we instead do is we focus on, there are 4 things that we discussed. The first one is focus. How should you spend your money? What should you work on? What not? But it's really the strategy of the company. Where does it go? The second one are all the team problems, co-founder problems, team build out, hiring, firing, culture, whatever. The fourth one is this whole sequence that goes from customer, product, then the whole category definition, go-to-market, master plan, and then the company build out. And the fourth area is fundraising. So then the problems are always the same. There are no, for me, every single problem that a founder comes with, I've seen before. There is no new problems. It's just different variants of existing problems. So we've actually written a coaching playbook where we say, here are all the problems. This is how we recommend you deal with them. Yeah. And so it's not every single little problem, but like the 7 or 8 really big ones that we see all the time that are company killers. We say, if you have one of those problems, you have to come and talk to us. It's super important. And actually, I think it helps. So it's clarifying the mind for founders what we're trying to accomplish there. And that's what we do. And then after a year, more or less, the founders would have raised another round. And hopefully then there are very good VCs on the board who do a similar activity. Hopefully that's how we do it.
How can founders better prepare for pitching to investors? What are your red flags in these meetings?
My red flags are very different from, I think, what the industry red flags are. I think there is this disease in the world which has been probably spread by Sequoia Capital, or it's just been there all along, but it probably stems from this being stuck in your own mojo, meaning if you're a founder, so what you do initially is you talk to customers and build product, and you talk to customers and build product, and then you happen to talk to an investor and then you pitch your product. And the reality is, I don't want to buy the product. I'm not a customer. I want to invest in the business. And so you're not pitching the product, you're pitching the shares in your company effectively. And investors will invest in that company. And when VCs write an investment memo, the investment memos, they all look the same. It says, here is a really valuable category that's emerging. This is why it's happening. Here's a proof that this particular company is actually getting really good traction in building this category. And we think it can really get there. And it's a very attractive deal to put them on. And every single document that I've ever read, and I get them, VC sent them to me, here's my investment memo, do you want to co-invest? They all look like that, man. Have you ever seen a pitch deck that looks like? It's like they all pitch it in a way where you just think it's completely detached from what investors are actually trying to write up in their documents. There's a real disconnect between these two. And I think it's either because Sequoia has put out this pitch deck template that is a little like that, or because founders literally think like that. So that is sort of that's not really a red flag for me in terms of investing, but the problem that most founders create for themselves is that they can't get the story across because they don't talk like investors think or have to think. And they're not pitching their shares in a valuable company, they're pitching a product, which doesn't really make sense. Red flags for us, categorically, irrespective of how they get pitched, is you want to see, founders fighting is incredibly boring. I don't want to invest in teams where the founders fight. So I've some time ago decided that all teams fight between months 6 and 9 of being together. So I no longer invest into teams where the founders haven't worked together for at least 12 months. I just don't do it. It's sort of like a self-preservation mechanism. Other investors can take that risk. And should unicorns emerge from that, okay, happy for other people, but I don't do that anymore. Then I'm just really trying to figure out, have they really listened to customers? Can they really articulate to me who exactly is the customer? What are they called? What is their name? And have they last spoken to them? What's the telephone number? Do they have an email address? What has that person said? What's the pain? Why do they need to give them money? How are they going to build a product? So I literally just go through this failure mode questions. But the reddest flag for me is like the team has not been together and doesn't know each other. That is something that I just don't do. There's too many things go wrong. The failure rate is far too high, and I just don't want to be involved with something that looks like this.
It is mostly said that early stage startup investment is more than spreadsheets. It is a psychology. So what is your decision process look like? Do you use your intuition and gut feelings more than data?
Well, there is typically very little data. So the way to look at it is there are quite a few ways to think about that, but when you look for the literature, there is an endless debate about, is it the team or is it the market? What really makes great companies and so forth, right? And the reality is that in super, super early stage companies, there is just team. There's nothing. Sometimes they don't even know exactly what they're going to do. And then the more you go towards late stage, the more it becomes market. At the end, the team is it's just, you just look at markets. Is this really a market that you want to be in? Yeah. And then at Series A stage, you have both. You have the crossover. And And that is really how, at the end of the day, those two things need to come together so that startups really, really work. Yeah. So, and initially when you're evaluating a team, the team evaluation doesn't happen by putting numbers to the right. It doesn't work because initially, and this is also when late stage investors go early stage, they typically don't know what to do. And this, if you've ever read 4 Steps to the Epiphany by Steve Blank, it will explain beautifully why this doesn't work. The problem is the founders will not have found product market fit. There is nothing that you can take and pull to the right. It just doesn't exist. So therefore, all the things that late stage investors demand, right? None of them are right. They actually lead a company down the path of premature scaling. It's a total waste of time. I think there's an article somewhere that calls it building house. It says you build a beautiful house that's completely empty with nothing in it, and at the end it's going to collapse because there's nothing there. So, and you see this over and over again when the Series B investors go to seed, they just don't know what to do and they lead the founders down the wrong direction. This happens all the time. And so that happens. So then the job of the early stage investors is to try and say, okay, tell them you're not going to spend the money. This is your plan. You have an intermediary budget until you found product market fit. And sometimes founders actually do that.
Follow-up question. Do you trust your gut while deciding investment decisions, or do you trust the investment committee decisions?
So at Techstars, this must have been 2000 or so. There was a data analysis that was presented to us where Techstars tried to figure out what kind of investment making process was likely the most successful. Yeah, so they had various different MDs in different ways and so forth. And so there was something that was presented to us around that. And the bottom line looked something like this. A very good managing director hits about 50% of all the good companies. And you can't really get much better than that. So you miss 50% of the companies always because you just do. And there's almost no point in trying to improve that. The bad managing directors, they miss all the good companies. Yeah. And then the question is, okay, so if you have the difference between being bad and good is hitting between 0 and 50% of the companies that you could potentially really make a difference in a portfolio. And we then figured out that we were told that it is more important in the early stage that there are individuals, meaning the managing directors, who are super passionate about a company or the other. And then everybody says, this is nonsense. And that partner says, fuck it, I'm going to do that. I'm just going to write the check. I don't care. I'm still going to do it. Yeah. Because the worst way to make decisions is by committee, especially in the early stages. Why? Because you just have all these different opinions and you cannot actually investigate these companies with enough interactions that you can make your opinion count. So what does that mean? Let's just say one of my partners talks to a startup 2 times. They really like the startup, right? So let's just say if we had an investment committee of 3 people and the other 2 people would have to talk to that company too, right? Then we would all have to come together and form an opinion on a company whose product probably doesn't exist, where they have very few customers. The market might not exist. It's super small. It's completely unproven. There are lots of things about this that don't make any sense. The probability that you have the companies where everybody is excited are probably the companies with a very poor risk-adjusted return profile. So therefore, what we do is we just say we have a feedback process where, so for example, one of my partners just said, I want to make this investment in this company. Here's a 2-page memo. I got it. And I said, this market is really well understood by these 2 people. And you should go off and ask them about this. And there's also this other company there. We should figure out how well that's doing. And if so, what the most critical thing is maybe about that company and how that relates to this company that you're thinking about investing. But if you do that, or whatever, this is basically my feedback. Do with it what you will, but it's your decision whether you want to make that investment. Right? So if that process is being followed correctly, then the partner can make the investment. But I'm not going to go off and delay an investment by a week or whatever and have my own opinion and I need to ramp up my thinking. It's a total waste. I would rather work on a different.
Did you see a pattern in the successful companies of your portfolio 2 ventures? Are there any patterns for the founders or co-founders of your portfolio?
There are 2 patterns that's probably worth talking about. So at Techstars, when we made investment decisions, there were quite a few people involved. The successful companies were always the ones where either everybody loved them or almost everybody loved them, or they were companies where the MD said, I love that company and everybody else hated it. And every company that was wishy-washy. And so everybody's like, I don't know, it could be interesting. It's like never turned into anything much. That was sort of the on a selection bias. That was sort of where what happened there. And then on the team side, the most unsuccessful companies I've ever invested in were the ones where the founders knew each other for less than 1 year. My hit rate there is almost 0%. They all went bust within a year. So it's like, this is why I don't do them anymore. On the other side, every other pattern. I mean, I know that I've talked to VCs that say, oh, we've analyzed this. We want founders who've been to these types of schools and have then worked there and then did this and all of that. I don't do that. I think that is extraordinarily silly because that leads to the kind of bias that we want to not have when we select founders. We want to invest in people who are highly intelligent, have enormous energy, and can really listen to customers and have a view on the world. Obviously, those will have gone to certain universities, possibly, or maybe not, right? But I wouldn't take somebody else's opinion, meaning some university administration or some parent decision or whatever, to say, oh yeah, that's a good founder. And that doesn't really work for me. So that's sort of, and also in our portfolio, when I look at the biggest success stories, I'm not sure that those founders have actually been to any of those places that you would typically go and look for the best performing founders. I don't think that's how that works. Yeah. So, for example, the company that I mentioned earlier, the founders are from Ukraine. I don't think they've been to any university that anybody knows. Yeah. It's like not in Western Europe, so sort of, or in the US. And the problem was actually one of them almost, his English was pretty rough. So he had never worked at a high performing technology company. Yeah, so I just think that those kind of ways of looking at the world don't really work for me. I try to look for attributes, not pedigree.
Do you have an investment memo template that you write after the calls or meetings?
We published it. Oh, well, I don't know. We haven't published our coaching book yet. It's what I learned from. So we have a memo template that's sort of based on a view of how we think about largely of how I think about startups, to be fair. Now, we have now got, 8 people who write angel checks. And what I would like to do is they all make very, very they have different ways of making investment decisions that actually lead to success. And there is a question mark around whether that template is enhancing the decision-making process. I mean, does it really improve results or not? And I think because what you can have is you can have a lot of unintended consequences when you push something like this out. You think you're adding value, but actually you're destroying value because that might work for me or for a certain type of person, but it might not work for a whole bunch of other people for different reasons. So this is one of the reasons why we haven't done that. At some point, so what we do with the coaching handbook now, we give that to all the founders that we back. And then because we found that to be more beneficial than not doing that. And we've gotten quite a bit of feedback on that through that. And I think with this, we've now given this to dozens and dozens of teams. And we think that there's much more ready for publication. Let me put it like that.
Are there any untold realities behind the venture capital world? The startups.
Yeah, I mean, it's obviously, most startups don't lend themselves towards venture capital. I mean, if you think about it, a venture capital fund has got a lifetime of 10 to 12 years or so. And let's just say you invest in a startup very early stage in year 3 of the fund, then you have to liquidate the position within 8 years or so, the latest 7 to 9 years. And there's a very small subset of companies that have the ability to scale to such a size in that period of time that can lead to the right kind of risk-adjusted return for the investor. And if you look at most really big successful companies that there are in the world, most of them have been built over 20, 30, 40, 50 years. It's really long periods of time because the compounding of these businesses takes a lot of time. And I think most companies are just not in the VC case. Startup is a very specific type of business that can be scaled with money in a very short period of time. Most companies simply are not like that. And that's sort of like, that's fundamentally probably the biggest disconnect between founders are looking for investors in a sense as affirmation that what they're doing is the right thing. I think most startups shouldn't raise any capital from any outside investors. If you spark with 2 founders, a company is doing 10 million ARR and you have 20% EBITDA margin, you can issue yourself million of profit per year, and you do that for 4 or 5 years, you're done. Why on earth? Like you can switch off and live on the beach for the rest of your life, and it's a complete waste of. Why would you run after investors and sell your company unless you have the opportunity and the ambition to actually build a company that's worth billions? Because that's the only reason, or the only scenario under which raising capital money actually works, both for the investor and for the founder. I think most founders completely overestimate how big the business can be. Most businesses can't be that big. Most businesses will most likely stay small. So in that scenario, you shouldn't raise from a venture capital fund. And the larger the VC fund is, the bigger the problem, because the more money it has to return. So the bigger the company has to be in the end. So that's probably the sort of the biggest thing. And then, and I would just say, don't raise money to look for confirmation that you're awesome. That's not what this is for. It's like if you put rocket fuel into a normal car, the car will explode. Rocket fuel is for rockets. Most people have cars, not rockets. So don't put rocket fuel into a car. It's bad for the car. So that's probably how I would look at it. And then obviously as investors end up putting rocket fuel into cars because they mistake the cars for rockets, but they aren't. And that's really bad for the cars. Luckily for all of us, the founders can shut down the company and do something else with their lives, So it's not they're not slave to the company forever.
If you weren't an investor, what career path might you have chosen?
Oh, that's a good question. Well, I was a scientist. I didn't do that. Originally, I wanted to become an astronaut, but then I broke my back when I was 12, and it's sort of not a good idea for me to go on a rocket. They wouldn't let me do that. I went now Untold anyway, but they wouldn't have let me do that. Actually, let me put it like this: if I wasn't involved with the technology industry at all, maybe the better way to say that is, if should I retire and I still have energy, then I'm really interested in 2 areas. One is I'm really interested in what I think is. There are quite a few diseases where the cause of the disease is unknown. So, for example, with Alzheimer's, if you look up Alzheimer's on Wikipedia, they'll say, "Oh, it's this and this disease," but actually, what it is, nobody knows. Yeah. Most of the neurodegenerative diseases are like that. There are lots and lots and lots of diseases where the cause is unknown. Depression. Nobody knows what depression is. It's completely mad how many hundreds of millions of people are sick and die of certain things. Nobody even knows how they work. I personally have developed this theory that I think of them as multi-cause diseases. They don't have a single cause, and this is why it's so difficult to figure out the cause. It's probably always an infection plus a genetic thing plus an environmental trigger or whatever. So it's multi-compound, it's compounding, they compound each other, and then you become sick. And I would really like to work in that area in one way or the other. And the other one is, I think that public servants in countries are, the way in which they're incentivized leads to, you have a real principal agent problem, because if they do what they're supposed to do, but they don't make the system in which they do any better. They don't think about better ways of doing things and then make things better, because nobody incentivizes these folks to do that. And I think there is a real mismanagement happening, probably globally. And maybe there's some countries that have fixed that, but I don't know. But certainly not in Germany, that's not the case. There is no categorical and automatic improvement of these services, because there's no system in place that solves this principal agent problem. The agents are not incentivized to do anything for the principal. They're just incentivized to follow whatever they're doing. And if you could solve that problem, you could probably unleash enormous societal productivity. And then when I don't do that, I restore antique furniture or something like that. That's sort of like something that I did as a job when I was a student. So I restore antique things. So that's sort of like, that's not something I would do for a living or anything. That's more of a hobby.
So what are your favorite activities or hobbies?
Oh, right now I just built my company. Trying to build my daughters to be awesome women. That's what I'm beyond that. I have very little time for anything else. I'm involved with some initiatives here on the public sector side to help shift that in the right direction. But beyond that, I really have very little time. I'm completely focused professionally on working with founders and helping them, build awesome companies.
What book or podcast do you recommend?
Books that we recommend that work. So there are several that really work. They do no harm, and they change the trajectory of how founders build businesses. So one is 5 Dysfunctions of a Team. So you can not turn somebody who doesn't know to manage into an awesome manager, but you can turn them into an okay manager, and you give them that book, and that book works. So that's really good. And then there there are a couple of books around category creation that can be really impactful. So one of them, there is one called Play Bigger, and there's a whole bunch of others around that area. And those books really change how company founders think about building companies. In terms of podcasts, I don't know. I mean, I don't recommend podcasts to founders typically. I listen to like whatever 5, 6, 7 podcasts that are all about, VC and making money and portfolio construction and building companies and how to be a good founder and whatever. That's stuff. It's all the usual suspects in there, and I don't have more time than that. Yeah. One I found particularly interesting is called Founders, where they just talk about it. I forgot the name of the guy who does it, but basically he reads the biographies of people who've built businesses and then summarizes them. Every week he summarizes another biography about all sorts of different successful people, and it's really it's fascinating how different and how similar all of those people are. So I like listening to that, for example.
Jens, thank you very much for your insightful and experience sharing. It was a pleasure to meet you.
Thanks for having me.